Hey guys, Freaky Finance here. Today we're going to do a fun one because all the big companies reported and we're overweight a lot of them. And I just want to jump into it and I'm kind of just going to leverage AI for a lot of this. But anyway, we're going to talk about Google, Microsoft, Meta, and Amazon. If you guys have been following the channel for a while, then you guys will know that I own all of them. So we have a relative overweight in Microsoft, which is actually still at a loss at the point of this video, which is nice. As well as we picked up ServiceNow, just a small position. We started putting a position into Reddit as well. And basically what I'm doing is trying to get long companies that I think are mispriced and based on what I'm seeing with AI. And we're going to talk about some themes because they're common across them. But a lot of it is, a lot of these companies are going to improve in a lot of different ways all at once from AI, both on the revenue growth side and on the cost management side. And I just think it's not being modeled correctly, or at least in the competitive set. Why are some of these companies cheaper than the market, all outgrowing the market by a material amount, and they're not having to hire to do it? There's a lot of stuff to go on here. Talk about the chips as well. There's a reason why I've basically trimmed most of my NVIDIA and why I'm long a little bit more AMD still. There's a reason why I also believe in like Amazon with the Gravitron chips, right? The Trainium, the TPUs at Google. These are all other things that I think are going to only continue. That's also why I'm playing Broadcom in the interim here instead of basically NVIDIA, kind of the rotation that I did as I went long, AMD and Broadcom instead of NVIDIA. But that seems to be more consensus now. All right, so with that in mind, let's jump into it. Basically, I got Claude to say, what's the similarities across these four companies' earnings calls this week? Its main points: you are seeing material growth and actually acceleration across all four businesses. The Meta was probably the outstanding in terms of revenue, especially with the reaction that the stock had to a 33% year over year revenue growth for companies of these size. You can see the dollar values. Amazon's ultimately a lot bigger than the others because it has a different business model. Its core business, the retail side, is rather large. They have a lot more employees as well. Than the other three, which we're going to see in a second. But anyway, you're seeing material growth. You said, we had the fastest growth since 2021 at Meta. You have Azure growth, again, accelerating cloud, which was insane for Google, with the backlogs all blowing out. We're going to talk about Google, but you can just see like the material growth we just talked about. The backlog nearly doubled Q over Q. That's just Q over Q, not year over year. Search revenue expanded, queries at all-time high. So we haven't seen a slowdown in queries, which is what people were talking about when they sold us Google 2 years ago or 3 years ago now. We're seeing material growth even on the ads for YouTube, and overall just material growth. Basically, the only reason why we're getting these deals is because everyone's worried about CapEx. Basically what's happening is they're going to have less labor costs and more depreciation through their CapEx cycle. And in terms of the cost structure, it's easier to scale off the CapEx spend than it ever is on adding employees, especially the employees that these companies have to add, because these are the highest paid employees in the world. So anyway, kind of rambling there, but there's a theme here that you're seeing, and you're seeing it over and over again. A lot of these companies are also a little bit on the advertising side. Microsoft's different, but for Google and Meta, you're seeing acceleration in ads, and I think it's because the digital ads is going to keep taking share, because the return on ad spend is only going to improve with AI, because the targeting is going to get so much better and so much more personal. And I think both business models are both going to accelerate. They just did, right? That's why Meta shot up 33% year over year in revenue. You're just seeing more and more ARPU out of Meta, and I think that's only going to continue. Like we saw the same with Google, the same quarter. Microsoft's slightly different, and I showed you that position, and I actually have that as a loss. It's one of the few ones that I'm holding as a loss. And this one, I just view it, I just zoom out 3 years, 4 years, and I can't figure out how I'm going to lose. Microsoft's probably one of the most exciting ones that I want to talk about today. And again, you're seeing revenue growth accelerate, the cloud revenue side. We're going to branch into Copilot in a second. I made Claude make a little Copilot upsell thing, but it is exciting, and we're getting decent prices on some of these still. Meta, we just talked about the advertising. They have started to lay off more employees, which we're going to talk about in a second as well. It's another theme that's happening with all four of these guys. And then Amazon, which I thought was probably the most outstanding one. If you had to listen to one of the calls, I'd probably say Amazon, and then maybe Meta would probably be the more interesting ones. Not that Google and Microsoft weren't. I just thought Amazon's was pretty interesting this time. Anyway, you're seeing acceleration across the board at Amazon. It's not often thought of advertising too much at Amazon, but that muscle has really grown real quick over the last 4 years. So you're seeing acceleration there as well, right? You have the custom chips business, which is triple digit year over year. So you're growing across all the avenues. And then I didn't even talk about Amazon for the robotic side and how I think robots are only going to get better quicker. I think they're going to, just like Tesla's getting better with their cars and full self-drive, I think robots are going to patch in and get more efficiencies over time as well. Now that's longer, but that's something I also think is not appreciated at Amazon, especially as they go more and more robotics and reduce their headcount, just like the others. Anyway, so common themes: AI is the primary growth engine, so they're not being displaced by it. They are AI. You can see it across all their business lines. There's a lot of CapEx that's not not true or anything. If you hear it, that is what's happening. They're basically replacing labor with capex, and you're already starting to see the acceleration in revenue in the numbers. They all mention supply constraint, not demand constraint, which is important for overbuilding. Add AI do a comparison to the railroad to the data center build out we're seeing now. It was kind of interesting. Maybe I'll share that at some point. It was kind of interesting to see what context it pulls, because it can go way deeper, like 1800s, right? I have no context on that history of that period, so it's kind of interesting. Anyway, you're seeing cloud and advertising simultaneously accelerating. That's what I expect. I do think advertising is going to get better. The whole matchmaking thing is why we still own Airbnb. It's why we still own Uber. That whole matching people, product to people, is going to just only improve. So whether you're Uber, you're quarterbacking at cars, Airbnb, you're quarterbacking traffic for hotels or for homes to stay on your vacation, only that's only going to improve. And then you have the workforce discipline. So basically, you're seeing layoffs across the business. Meta cut 10% of staff. Amazon cut 16K corporate roles, right? They've been hiring selectively while keeping headcount roughly flat. And that's with material growth on the revenue side. There is a lot of capex, and that's the only reason why I think you are getting the deals you're getting in them, and why I think they're still cheap, especially relative to the market, especially say a company like Meta at this current point in time. Anyway, the valuation scorecard. I made AI run this twice because it screwed it up the first time. So I take these forward Ps with a grain of salt. Like, I don't think Google's actually at 29. Like, I don't expect no growth in Google's earnings year over year. So there's certain things like that. Like, really, you just expect Microsoft to barely grow year over year, even though they're showing like double-digit EPS growth right now, right? So anyway, but what it did point out is that a lot of these companies, like Meta, is actually cheaper than the market. Well, it's growing materially faster than the market, right? Market's growing about 10% revenue. Not bad. I'm getting pulled up by these guys. But you can see Meta's at 33%. So I've tripled the growth rate at a cheaper valuation, right? That's currently what's happening. And people, like, if you talk to people, they still think the Mag 7 are super overpriced. I'm like, it hasn't been. There's a reason why I own 4 of the 7, right? It's just, in my mind, the competitive set here and the opportunity that's ahead of us for that last part of this decade is just amazing. I don't think I've ever seen it like that, right? Amazon was when we did the video a while ago, it was one of the cheaper ones, though it has appreciated since the time of the video. Yeah, a decent amount. Same with Google, right? They're at the 52-week highs. So the ones that I'm looking at this week is going to be Microsoft and Meta again, and see if I can slowly trim the garden, maneuver a little bit. And usually what I do is just trim some winners that shot up a little bit too quickly, and then buy some of these losers, because I do believe in them long term. And you never know how cheap someone's going to sell you things too, right? Right. I did put Netflix in here too, just to show that I do own that one. I have started a position in it, not material, or a decent sized position. It's not a crazy overweight like Microsoft or Amazon, or crazy overweight, but not an overweight. Most of these positions are still less than 10%. Usually anytime a weight for me is 5%, and usually when I'm aggressive, it's 8%. I usually don't go crazy and go double digits, or some of these hedge funds that have 20% in a specific stock. I just can't deal with it, because I just like to slowly trim and add. So it's hard to do that strategy with the gardening strategy with very concentrated bets, because you really have to believe in the business, and you need to ride out big losses if you're wrong in the short term. And I like to be fluid and agile. So anyway, I just want to point out that I do own Amazon as well. And yeah, you can see the 4 Ps for this, guys. I just think they're silly. They are cheaper. You can see 3 of them are cheaper than their long-term average to themselves. So they're all actually cheaper than usual at the time, at the cups of an inflection that you're seeing in earnings right now today, right? Now, I could have said this about Google, that it was cheaper than its average, but Google was cheap for the last 5 years. And that's why we owned a decent sized position. That's actually where some of these positions came from. That's where some of this Amazon position came from. It's from selling Google and going into Amazon. Not that anything was wrong with Google. It's just I need to trim some of the winners and cycle it into another company. And what was a good opportunity is that Amazon, the cheapest it's been in a decade. Actually, it's the cheapest almost since it's a public company. So anyway, that's what we're seeing right now. In terms of the growth rates, this is what I also like. So not only are most of these companies cheaper than the market, they also had a material acceleration. You're seeing that across all of them. So this is just total revenue that includes the cloud revenue, but you're seeing material pickup at Meta. You're seeing a material pickup at Alphabet. So again, and that's the advertising, I think, is showing up a lot stronger, quicker. And I do think that advertising flywheel is just going to improve for digital advertising. And then you also have the slow upstick in Microsoft, and then the acceleration in Amazon as well. A material acceleration. Amazon is a bigger revenue company, so it's harder to get that growth rate up. So the fact that it's even close to Microsoft, I think is a testament to Amazon. Maybe a weakness of Microsoft, right? There might be a reason why I have a loss in Microsoft currently, right? With a material gain in Amazon. This might be part of the market pricing and the current revenue growth rate. In terms of the cloud, it's off the charts. So AWS, like we mentioned, the best quarter in 15 quarters. You're seeing material growth in Azure too as well. They just put up 40 again. And then you had Google, which was off the charts, both in terms of the growth rate that they booked and the backlog. The backlog for all these companies in cloud is material. It's huge. And yeah, that just what I like here is that you have this nice setup where things are cheaper than average still. And you're having acceleration at the same time. And to top that all off, here's just the headcount tracker of the big guys. So I got Claude to run the layoffs. And I was like, okay, map the headcount of Google over time. And it does. And you can see the slope of the line was growing pretty good. And not like Google was putting up bad numbers. There's a reason why these companies were outperforming the market and continue to outperform the market, I think, over the long run, is because you are seeing, despite all this headcount growth, they were putting up really strong revenue numbers. And now they're putting up even better revenue numbers, and they don't have to hire to do it, right? You've seen the slope of the headcount stop at 2022. And that's impressive because these things are growing 20, 30% year over year each year for the last 4 years, right? It's not slowing down. And so even Meta, similar trend. Facebook, right? You had a steeper going into 2022 and then a flat line after. Microsoft, again, steeper going into 22, flat line after. Not as extreme as the other two. And Meta is a little bit different because they had their year of efficiency, right? Which is one of the reasons why the thing rebounded as hard as it did, is they made some material reductions in headcount in 23. Not that the other ones didn't, but Meta's was a lot starker. Amazon, I have to change the scaling because Amazon just has so many employees, which I think also helps just visualize, because they are a different business model, right? Amazon has a big retailer. There's a lot of drivers around with Amazon vans, right? There's a lot of headcount here. Anyway, you're seeing that as well, flatline. So similar trend. Actually, Amazon peaked the year before, which was interesting. But anyway, you're just seeing the labor not needing to hire while still generating 20, 30% revenue growth. It's just a special time to look at the companies. I did want to reconcile the forward earnings. Like you saw in the thing, like Meta is at 20 times forward earnings on that, what Claude says, and you look at, say, Finviz is at 17. Forward earnings really depends on what you expect the earnings to be, and it depends where they pull it. So I've seen so far, that's another thing I've seen with AI, is certain times it pulls certain information, and I don't know if it knows how to weigh estimates yet as well. Like it might just take the average of its 5, or if there's, I have found with smaller companies it's even worse. Like it tries to put the consensus EPS estimate instead of its own like model. So what I found is you need to make AI build the model for the company and then calculate its own forward PE. Because if you try to do consensus, it seems to pull consensus EPS all over the place for different companies at different times. It's not consistent enough. But anyway, I used to have Google at 16, 17 times when we were buying it. Now it's at 27. Now it's technically the most expensive of the 4 we own. I still have the big overweight in Amazon. It's the big overweight in Microsoft because I think it's just ridiculously cheap relative to the market. And then I'm picking up certain things that again, with software, I was okay. I gotta pick up Now because I just think it's mispriced. Pick up some Uber because I think it's mispriced. Pick up some AppLovin, think it's mispriced. Pick up some Reddit. So a little bit more tech than what I'm probably used to running. But that's just where I think the opportunity is at this specific point in time. Meta's thing, just out of interest to show you guys the trend, because I've followed Meta for a long time now, and I've been in and out of it for a long time, and I do own Meta, is the Q1. So I was expecting Q1 to be pretty weak, because normally Q1s are pretty weak. You can see it's the only time revenue pulls back. It's like Q1, Q2 slight increase, Q3 slight increase, Q4 amazing. Q1 weak, same trend, right? But now you're seeing this week Q1 didn't really happen, right? Normally you can see Q1 barely beats the Q3 the year before. And this time the Q1 was 10% higher than the Q3 just 6 months before. We're just seeing material revenue growth across the line in advertising. You're seeing nice ARPU pickups. You're seeing Asia Pacific actually finally start showing up again, which has actually been a weakness for a while. This video is a little bit long, so I'm just going to go really quick here through Microsoft. Here you can see the Copilot momentum. So you are seeing material increase in Copilot. It's still severely underpenetrated. Here's the penetration slide that I like that Claude made. You can see it's just 4% of their user base. So 20 million on 450 million is a 4.4% attach rate. So they're still severely underpenetrated. And the uplift when they do see more penetration, it is material, right? Instead of going from $36 a user a month, you go to 57, you can go to 87 if you're going E5 and Copilot. So material uplift. And you are starting to see more and more pilots switch over to more and more seats, Accenture, Bayer, Johnson & Johnson, Mercedes, and Roche. And you will see, I think, this trend continue. I think it's the easiest upsell there'll ever be. And this is with a 4% penetration, when I think Copilot's probably the worst it's going to be at the specific point in time, right? Like, I think Claude's amazing. I've used Gemini when people were saying Google was behind, and I use Gemini and Claude basically exclusively. But I do use Copilot every now and then, especially for security purposes. That's really the only time I've used it. Otherwise, I just find Claude to be quicker. But anyway, and Microsoft will be, I believe they're moving. That's what the market, I think, is starting to entertain, is moving to that model agnostic instead of just being with OpenAI. They're going to be able to switch in Claude, right? Like, there's a reason why I have the Claude plugin on my Excel, and that's only going to get better. And I think having a security with Copilot into the existing business, I just can't visualize a world where Microsoft loses unless their models are so bad and someone creates a Microsoft suite of products that competes, that even though all the humans are trained on the Microsoft's offerings, right? And maybe a few tech companies are trained on Google's, but that's really it, right? There's a huge moat here for Microsoft to protect, and it just has to show up and not be too far behind. And I think it's going to be able to do that. Anyway, I'd like to know your thoughts. It's definitely an interesting time to look at these guys. Like I said, a lot of these are actually cheaper than what the AI is showing here on a forward. A lot of them are actually cheaper than the market already, even though they're all outgrowing the market and they're not having to hire to do it. Anyway, I'd like to know your thoughts, and have a great rest of your day.